First of all, I want to welcome you all to the FX Street webinar education series. My name is Steve Patterson, and this webinar is going to be specifically about why technical analysis works and why it doesn't. Okay. I'm just going to hopefully get this disclaimer out of the way. Okay. So none of you guys sues me or them. All right. Once again, my name is Steve Patterson. I've been trading for over 27 years. Currently, I'm an individual trader. I also do some managed accounts and some private coaching, et cetera, et cetera. I won't talk about me too much. We're going to talk about this the topic of this seminar. Now, I did my first webinar for FX Street last Thursday, and I got a lot of questions, and I kind of rushed through the webinar, and then a lot of people were emailing me, and I asked a lot of people to come back and ask questions in my next webinar. So what I thought would be cool, and hopefully you guys can tell me if this is something that you'd enjoy, but I'm going to kind of do this like a lecture series where I'll talk about the things that I want to teach you specifically today, but I'll also open it up to questions because it's one thing for me to discuss my views on the market and the things that I do, but it's kind of useless to you unless you can, ask me very specific questions about, anything specifically that you have in mind, okay? So just to start off, I'm going to answer Soulman's question. And Soulman asked me, "Hi, Steve. I've asked a few experts about your liquidity run stop loss phenomena, and the experts all dismiss it as just conspiratorial thinking. What do I say to that?" Well, Soulman, I guess I have to give back all the money that I made. Because, I've made a lot of money from doing this. And if it's not real, then I guess I got to give it back. So my answer to that is it is conspiratorial thinking. But unless it's some type of phenomena that is just me getting lucky a lot of the time, then it obviously works. All right. Yes, I do a little bit, Luca, but I'm going to talk a little bit about liquidity runs, and I'm going to talk about how the market works. I'm going to talk about specifically the topic of this thing, and my whole theme, just so you guys know, okay? We're going to be doing hopefully 4 webinars for FX Street over the course of each month. So my whole theme is going to be about liquidity and how I view the markets, and yes, it's going to play into it, and it's always the underlying thing that I do. So any of the topics that you guys want to follow with me along, we'll have that as an underlying theme, all right? But I also want to talk about things that a lot of traders struggle with in their development, because my way of viewing the markets, and some other people that I know that view the markets the same way I do, it's important, but it's also important to understand the context, and that's kind of the next topic of my discussion, because I am a firm believer that there's many ways to the top of the mountain, right? And to me, trading is like this big giant mountain, if you will, and you'll picture that. And I know guys that make a fortune from options. I know guys that are quants that make a lot of money. I know guys that are day traders that make a lot of money. I know guys that are swing traders that make a lot of money. I know guys that use technical analysis that make a lot of money. I know guys that use price action that make a lot of money. I have a lot of friends in this industry, and I've seen people use various ways to capture wealth from the market. So I always try to keep an open mind to everything that I'm doing, and I'm constantly reinventing myself, right? And so I don't ever like to say there's one way to do anything. As when it comes to the markets, the way I like to look at the market is to look at all the various ways that there are to trade, and then to develop something that's very personal to you. And for any of you that have ever read any of Brett Steenberger's books, I just summed up his entire pieces of literature, and I think that's really, really important because people use technical analysis to kind of get back on the subject that we're talking about here. People use technical analysis in a way that they're trying to, and here's the mistake, and might as well jump right into it. The mistake is when people start putting technical tools onto their chart, they've got it all wrong, all right? Because what they're trying to do is they make the mistake, and this is just my experience. I'm not saying everybody does this. I'm generalizing here, okay? But they make the mistake of assuming that the technical tool is the market. And so what happens is it's like going out with a beautiful woman and all you see is her beauty. Well, that's not what she is. She's the personality behind that, right? And so when people start throwing technical tools onto charts, what happens is they lose perspective of what's really happening, okay? Now, I want to quantify something. And don't worry, guys, we are going to talk about order flow analysis, okay? But let me get back to the technical tools. So at one point in time during my 27 years, I took apart pretty much every single technical tool that ever existed, and I tried them out, okay? I found their strengths, and I found their weaknesses. And I fell victim, just like everybody else did, to getting lost in the technical studies. And at one point in time, I literally had I think I had up to 7 indicators on my charts, okay? And so I understand the trap that technical tools provide you. And what people are looking for when they start to add these technical tools on is they're looking for an easy answer to a difficult question. Okay, does that make sense to you guys? They're trying to say, okay, well, all the books teach you that, you know, if I put this tool on and when this particular tool does this, then it means something. Okay. George, no, I'm talking about a technical indicator, an oscillator, a moving average, all the various technical studies that are out there, okay? Okay. So what's happening is that you apply a moving average and you say when the moving average crosses, it is a signal to do something. Okay, but that really isn't what it is, okay? What you're looking for is an easy answer to something that's a very complex question. And that is, you know, currently what is the market doing, right? And when you fall into the trap of using a technical tool like that, it's pretty much, you know, you're pretty much digging your own grave because you've lost perspective of what the market actually is, okay? So that is the main theme that I want you to keep in mind right now, okay? Whenever you use any technical study whatsoever, okay? Yeah, I'm going to actually get to my charts trying to trade. Whatever you use, any technical tool, you have to be very cognizant of that fact, because what will happen is you'll fall in love and you'll begin to trade that tool and you'll begin to trade that study rather than rather than keeping perspective on the markets. All right. So that is why technical analysis fails for so many people, because it's human nature to be able to, you see a trade, you study the trade, you get into the trade, and then all of a sudden your technical signal says, go ahead, make that order, and now you have fallen in love with that technical signal. Okay? And so you've lost perspective at that moment in time when you are trading technically. So let's actually take a look at some stuff here, okay? Let's look at some comparisons, right? I'll talk to my chart. I'm going to actually get to my charts right now. I have to turn this off and turn this on. Be right with you guys. Okay. All right. So let's look at some charts here. First of all, can everybody see my charts? Okay, great. Just the one Aussie dollar 1 hour chart here. Okay, fantastic. All right, now, right off the bat, whenever you have a simple bar chart, okay, whenever you have a simple bar chart, you're using a technical tool, right? A bar chart is nothing more than an indicator which is representing whatever price you're looking at, okay? And so when you're using a simple bar chart, a lot of people even get lost with bar charts. What's it meaning, right? What is this representing? They actually think this is the market, right? Well, it's not the market, right? This is not the market. The market is what's going on the electronic exchanges right now. Back in the day is what was happening in the pit, and price oscillating back and forth. Okay, so right off the bat, even a simple bar chart is a big lie. Okay, because all this is a historical representation of price and how price was moving, right? So people even can get lost in simple bar charts, right? So what I want to challenge you to do is I want to challenge you to look beyond that, right? I want to challenge you to look at what is actually happening. This is a representation of historical price levels. That's it. Okay? So even a simple bar chart can become a drug. It can become something that you become dependent on, because, people will look at these back in the day when we didn't have a lot of technical indicators. They'll look at this and they'll think that this is the market, right? But it's not the market. It's a historical representation of what the market was doing. Okay, and so there's a very, very succinct, different. I don't know if I said that word. Succinct? Yeah. Okay. Whatever. There's a very specific difference there. All right. This is not the market. This is a historical representation of the market. Just start with that premise. Okay. So now, if I'm looking at a historical representation of the market, I now can keep focus on what's relevant to trading. Okay. It's not this candle, this candle, this candle, this candle. It's what the market did when it was at those historical levels that's important. Okay, so I remember, when you're learning support and resistance, people will say, well, do I need one touch? Do I need two touches? Do I need three touches? What's a resistance level, right? What's a support level, right? And so, again, people get lost, right? And they say, okay, well, you know what? like this can become a drug in itself, right? So I need to find the support and resistance levels on the Aussie dollar, US dollar. So I need 4 touches. Well, there's 2 touches here, there's 2 touches here, there's 3 touches here, there's 4 touches there. So this is a support and resistance level on the Aussie dollar. All right. And so there's all these rules that have developed by various people to help you find support and resistance levels. And everybody's got their opinion of what a support and resistance level is. Some people say, no, this isn't the support and resistance level. This is the support and resistance level, right? And then some people will say, well, no, that's not a support and resistance level, yada, yada, yada. And again, once again, you have to really keep perspective of what you're looking at. You're looking at historical price levels where the market did many things, okay? Now, I know this sounds really, really stupid, really, really simple, and I'm sorry if I'm belaboring the point here, but and some of you may already know this, right? But it's really important to change your perspectives as a trader. If you ever want to be successful, it's your perspective that's keeping you back and holding you back from profits. Because if you're looking at something and you're not seeing what's really there, then how can you possibly exploit a situation? Okay? And that's what we're about. We're about exploiting various opportunities, okay? And again, this all ties into liquidity, and this all ties into liquidity campaigns where markets are moving. Because I can assure you this, the people that move markets around, all right, beyond the regular supply and demand dynamics of we talked about this in my first video that I did. The people that are moving the markets around, they're not looking at the markets as far as what an oscillator did or what a moving average did. Okay, as a matter of fact, they want to know where those things are because it gives them ability to move the markets around in ways that they can exploit you. Okay, now I don't want to say technical analysis is some big type of scam that was invented to keep dumb traders dumb and the rich traders rich. I'm not saying that, but unfortunately that's kind of what it's turned into. All right. We're going to get to the pros of technical analysis because I do believe technical analysis is something that can be used to help you make decisions. But it has to be used in the context that it was designed to do. And what it was really designed to do was to help give you a visual representation, right, of how to make a decision in the context that you're making that decision. Okay? So let me give an example. We're looking at the Aussie dollar here on a 1-hour chart. Okay, now I had some biases on the Aussie dollar that have been short all week. Okay, well, since Monday, right? And I use various ways. I also use sentiment in my trading. But so my attitude was if the Aussie dollar ever does a liquidity run, I was going to fade it, which means I'm going to sell at a level that I believe there is resistance. Okay, I'm not looking for I'm not looking at the charts, letting the charts say to me, okay, well, you know what? There's 3 touches here, there's 4 touches here, so we're now at resistance, so I can sell at this level. I'm not falling in love with 4, 3, 2, 1, whatever, trend lines, whatever. That's not the way I'm looking at the market. I'm looking at the market and saying, okay, if I want to get short on this Aussie dollar, okay, because my sentiment analysis on it is that, I'll get to that, ATM. My sentiment on it is that if a liquidity run happens to the upside it's going to end really quickly because there's not enough participants that will take that liquidity run too much further. And if natural supply and demand doesn't kick into the market, then, and only then, the market will collapse. So when I was looking at the Aussie dollar, and unfortunately it happened this morning on a London session, I couldn't really participate in it, but I was looking at anywhere around this area and this area and this area because I knew there was liquidity up here, right? There was liquidity here, and I knew there was liquidity here. And I didn't know that. And does it happen to be coincidental that these are highs and lows? Well, it's not really coincidental because if you think of it logically, anybody that is short on the Aussie dollar and is in profits is going to want to protect those profits. So just using a little bit of common sense and using what people call swing highs and swing lows, and this is, you know, another way that people are trying to confuse you. Okay, well, you know, the market's in a downtrend if it makes a lower high and a lower low. The market's in a downtrend if it makes a lower high and a lower low. So therefore, this market is in a downtrend, right? But wait, what happened here? We took out a lower high. Okay, so is the market still in a downtrend? Well, I don't care, right? Because well, you're all, and I don't mean this to be sound condescending. Well, you're all looking for lower highs and higher lows, etc., etc. I'm not looking at the market like that anymore. I'm looking at the market from the perspective of this is historical price, right? And in the context of what's going on, how can historical price help me make a difference? Okay, so for example, we had, you know, the QE3 announcement that happened yesterday afternoon, right? And the market shot up. And then sure enough, after that announcement, the market went up and took out all this liquidity. Okay? It took out the liquidity here, it took out the liquidity here, and it took out the liquidity here. Well, what happened was the actual players that were involved used this excuse, if you will, to run into these stops. So anybody that was short on the Aussie dollar, right, and I do believe the Aussie dollar is going to continue to fall because I'm reading how the market is flowing and I'm reading the order flow of how the market is behaving right now. Anybody that was short now probably got stopped out, and so now it's going to be very easy for the participants to move this market lower. All right, and I did a blog the other day, and one of the guys that I like in Forex Factory, his name is Keith. I can't remember his last name right now. Anyways, he put up a post to one book, and you know I have 3 books that I recommend for people, and that is Reminiscence of a Stock Operator, the Market Wizard books, and I also recommend that you read Disciplined Trader. Okay, I don't think you need anything else other than that to, you know, develop something that is going to be profitable for you. So let me get back to the topic because I've got about 20 minutes left. Okay, but in that book, Reminiscence of a Stock Operator, you learn that markets not only move on supply and demand, but they also move on lack of supply and demand. All right. So if this market is going to move lower, all right, then the market's going to move in its natural forces on lack of supply and demand as much as it will on selling pressure. Okay. Let me just answer a quick couple questions here. Steve, are most liquidity runs collective moves in a trend? If so, do you wait for the corrective move? So here's an example, okay? Because people say to me, you know, what's a liquidity run? Well, I highly doubt that this was a liquidity run because this was just natural supply and demand. But I can tell you, at this particular point, there were enough traders that were what I call large players that would see this liquidity here, that would see this liquidity here, and they would see this liquidity here. So the move from this area up to take out these stops, and these stops was guaranteed to happen at that particular point in time. And I know this was a liquidity run because I can look at this one candle here and this one candle here, and I can see bam, stops gone, bam, stops gone, bam, stops gone, collapse. That's why I know for a fact that that was a liquidity run. That's not supply and demand. That's not anything else but some very smart people taking advantage of the orders up at these levels and the ability to get rid of them. Okay? And so, is it conspiracy? Yes, there is a conspiracy. The conspiracy is to make money. The conspiracy isn't out to get you particularly. The conspiracy is that there are lots of traders on desks right now that their main job is to do what you're doing. They're like, don't take this the wrong way, they're real traders, okay? And a real trader doesn't really make a trade unless he knows that there's a high probability of that trade actually working. But the way he's looking at his probabilities is very, very different than the way you're looking at probabilities. He's looking at probabilities from the perspective of, is there a guaranteed buyer or seller, or a relatively high degree of guarantee that there's a buyer or seller that I can liquidate my moves into, okay? I will try to get to all these questions in the last 10 minutes. I'm going to just try to go through about 10 more minutes of talking, and then I'll try to get to as many questions as I can in the last 10 minutes. All right. So hopefully, once again, I've got 45 minutes here, guys, and I'm trying to take 27 years of knowledge and put it into 45 minutes. Just ain't gonna happen. All right. But what I can do is give you some gems of information that can hopefully begin to help you take a look and change your perspective from what I believe is really, faulty thinking about how to view markets. Okay, so let me just move on here because I want to actually talk about using indicators. So looking at a very simple chart here, I see a liquidity run that happened up in this area, and had I have been awake at that time, I would have been all over the fade of that, and I would be now looking for the market natural dynamics to take place. And a lot of people think, well, where's the liquidity? Well, liquidity runs only happen when it makes sense for them to happen. Okay, and that's why, down here, for example, I'll be very honest with you, I was short the day before on a swing trade here, and the market moved down into this area, and we took out some liquidity around this area, and I honestly thought we were going to take out these lows. So I was really shocked when we didn't. And then, of course, the whole QE3 announcement ruined my party completely. I actually ended up taking some profits on this trade, but I didn't lock in as much as I really wanted to. And now, once again, I do believe the natural dynamics and this liquidity run happened up here, and I don't believe we're going to come down and look for liquidity down below. Okay, but specifically when a run happens, it's usually when we get close to areas. Okay. So let me just not get too off topic here because I want to talk for 5 more minutes about indicators. Okay, so here's a naked chart. Now I also do use indicators occasionally, and here's what I'm going to recommend you do. If you do want to use indicators, continue to use them, but always start off with a naked chart. And remember, this is not a bar chart. This is historical price levels. Put that into your mind right away, and you're going to be like way ahead of the game. Okay, this is not support and resistance. This is not a trend line. Okay, because now you're attaching a label to something that um, this was a trend line. Well, the trend line was broken. You're attaching a label to something, so you're falling in love with something that isn't real. You're falling in love with something that is only a representation of what price particularly did at those particular levels. Okay, and so when you call something a trend line, when you call something a higher high, when you call something support resistance, faulty thinking. Okay, faulty thinking. Okay, and if you're ever going to get profitable in this business, you're going to have to change your thinking about what the actual markets are and what charts are. Okay, so let me actually pop up something here real quickly because I do want to get to that. I do use indicators still, and I have a particular set of indicators that I've developed through the years that I find helpful at times. And sometimes I will pop up my indicators to help me gain a greater perspective. If I need to make a difficult decision, then sometimes I will pop up my indicators to help me make that decision, because look at the difference. I mean, look at what this looks like versus what this looks like, right? It's like two entirely different views, right? It's like it's like entirely different views, and when you're looking at this indicator, if you're not careful, right, you can begin to miss what's really important. Okay. Yes, that's a MACD, and this is a 13, a 26, and a 50 MA, and I use some volume down here occasionally as well too. Okay, so let's say you get into a difficult situation where I'm not really sure whether or not I should be buying or selling. Okay, now, for example, I have very specific criteria. There are times when I am an aggressive trend follower, and there are times when I'm an aggressive reversal trader. Okay, and it depends on the context, and that will be the topic of my next webinar next Thursday. Is context is really important. Okay. Yeah, I don't need the signal line. Okay. But so, for example, here's a situation where I was considering looking for a short on the Aussie dollar. All right, and so a lot of people tell you, well, you have to trade divergences. Okay, and we all know hopefully we all know what a divergence is. But we've got price making higher highs here, and the MACD is declining. So we have triple divergence on this particular situation. Well, there's a whole slew of you out there that are running around looking for triple divergence and thinking that triple divergence always means the top. Okay, well, you would have got your butt handed to you in this particular situation if you would have been looking for triple divergence, because the market ended up coming down, doing a liquidity run to the lower part, and then doing a liquidity run up to take out all of the highs there for all the, suckers that were trading triple divergence. Okay, and so how can using technical tools help you? Once again, when you're viewing the market from the perspective of what it is, and once again I'm going to go down to a naked chart here. Okay. When I was looking at this particular level and considering that the market might be topping in this level, and I wanted confirmation that it was potentially topping, right? And where it was topping, I was actually trying to figure out, okay, well, if it is topping, where is the safest place because prior to that, we were in a very strong move. Okay, so when I wanted to find out whether or not it was stopping at this particular level, I was able to now go and say, okay, look at, I don't know if this is a top, but I think this is a particular top in this particular area because of the historical price movement. Okay, and when I say historical price movement, I saw price move from this level up to this level, and then price moved back down to this level, then price moved up to this level, then price moved to this level, then price moved to this level, then there was a liquidity run down here, and then there was a liquidity run to the highs. Okay, and at this particular time, if I wanted to fade this particular liquidity area because of the context that I was developing as a trader based upon my price levels, I could now pop up my indicator, right? I can now pop up my indicator template, right? And I could now say, okay, can I use these indicators in any way that would help me make this decision that I've got to make easier? Okay, so I won't get into the specifics of how I'm using the indicator, like, okay, there was divergence or a moving average crossover or anything like that, because that's not the way I'm looking at it. I'm looking at it and saying, okay, does this oscillator here, which we call the MACD, does this oscillator here on this MACD give me any type of clue that I should fade this particular level? Right? Is it giving me any type of clue? So forget about how I'm using the indicator. That's not what's important, because you guys all know indicators and you guys all have read about the strengths and weaknesses of various indicators. So if you're going to use an indicator, study what it does and then apply it. How do I do that? How do I refresh my cam? Can everybody see my cam? Can everybody see my charts okay? Okay, Fernando, maybe you could just log out and log back in or something. Okay, so when I'm looking at the use of an indicator, yeah, I'm looking at it from the perspective of, is the oscillator doing what an oscillator should do as I make that higher high? I don't have an RSI. I only have the MACD and a couple of moving averages. Okay. Okay. So if you're going to use indicators, and where indicators can become very powerful for you, okay, is to use them in the context of historical price movement. So for example, if I wanted to say, okay, should I fade this stop run up here, or this liquidity run here, is my indicator giving me also some confirmation that I should take that fade? And, you know, if we draw a line here, I don't even know what this is because I didn't look at it, but, you know, I do believe there is, you know, some people would say that this is support and resistance on an indicator. Well, this should have gone higher. The oscillator should have gone higher as we made the higher high. So in reality, this is a form of divergence. So even though I was pretty certain I would have faded this area, okay, I could have used my indicator to help me decide to take a short at this level. Okay? So does everybody kind of get, I got 5 minutes left here. I'm going to answer some questions. Does everybody kind of get the gist? I don't expect you to understand it 100% right now. Does everybody kind of get the gist of what I'm trying to change your thinking? How I'm trying to get you to view what the strengths and weaknesses are of even something as simple as a bar chart, and you know, all these chart with all these indicators on it is nothing more than just a more complicated bar chart. Okay, so quickly, I hate to say this because I can't scroll up. Can you guys ask some quick questions? I got 5 minutes left here. Gan asks, so if you make your decisions with price and you see if you can get a clue with your indicator, let me just make that bigger. And if you're iffy, I'm not sure I understand that G and N, right? Mike asks, a 200 SMA would be useful too, since many traders look at the market and respect it. Mike, quite honestly, I love the big moving average numbers because a lot of times stop runs go into those big moving averages. Okay. How about higher time frames? Aaron asks, how about higher time frames? What do you mean specifically, Aaron, about higher time frames? Everything I show you right now happens on every level. Okay. Thank you, Keith. There he is. Hey, Keith, how you doing, buddy? Keith put that post up. I highly recommend that you read Keith's post. This is an excellent post. Okay. What clues? Cyril asks, what clues are about to happen that liquidity run is about to occur? Yeah, I mean, really, you have to follow. You have to follow the actual. When I'm watching these ticks go up and down, let's say I'm watching a 1 minute chart, just so I can emphasize it right here. When I'm watching these tick go up, let's say I thought there was going to be a liquidity run to this level down here, right? I would watch how price was actually moving. Okay, I'm not looking at these candlesticks and thinking there's a candlestick. I'm actually watching if when price is moving up, is it struggling as it's moving up versus when it's moving down. Okay, so let's say I thought there was going to be a liquidity run to this particular level on a 1 minute chart. Well, price was moving up. What was happening to it as it made those moves up, and what was happening to it when it made those moves down? Because when a liquidity run happens, most people don't understand that the participants that are in that particular liquidity run, what they're doing is they're judging whether or not they should continue or whether or not they should stop based upon the amount of orders that they're running into. So let's just say, for example, there was a market participant that wanted to move the market from here down to here. And he thought, well, you know what? If I sell at this level and I sell at this level, 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 I got a guaranteed buyer down here, right? He may try that particular move, he, she, whatever. And if they're testing it, okay, as they're pushing that market down, they're testing those orders, okay? Now, if all of a sudden a big order steps into the market, they'll abandon that run. They'll abandon it. But if they test it and they move 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 it and they're not getting any type of resistance coming into their campaign, right? Then they'll just continue to move it, move it, move it, move it, move it, and trail a stop. Okay? Because remember, they're averaging into a winning position. Okay? Whenever you're averaging into a winning position, it's always a good thing, right? Because you can always trail your stop to your average price if you really have to. Okay? And once again, it's a deep topic that would take much longer than 45 minutes, guys. And I believe, Maud, you can correct me, but I have to leave at 45 today. Can someone confirm that I have to actually finish at 45 minutes? Maud, if you're listening. Oh, okay. 5 or 7 more minutes. Okay, thank you, Maud. Very sweet lady, by the way. If any of you don't know Maud at FX Street, she's really super cool, and she's I think you're great, Maud. Okay, I'll continue here. Let me go to some of these questions. Okay, if smart money chases stops for liquidity, which are generally counter-trend moves, whose money keeps the market flowing in a main trend? English asks a fantastic question. Okay. English asks, whose money keeps the movie in a general trend? English, supply and demand. Supply and demand keeps the money moving in its general direction, right? And also regular arbitrage. Corporations that are just doing regular business each and every day and are protecting their profits, all right? Andy asks, don't liquidity runners play against each other, which means sometimes they also lose? Andy asks a very excellent question, and the answer is yes. You're absolutely right, Andy. It happens, right? And it's very much a big poker game, okay? Especially not so much in the forex markets, but especially if you take a look at this on the ES or the Russell or on some of the other markets. It's a huge poker game that goes on, and very much like poker, the one with the most amount of money usually ends up winning that. Okay, so that's very interesting, right? Mike asks, Steve, for your order flow analysis, do you use special data feed, eSignal, DTN, or updated ink? Well, Mike, the answer to that question is, depending on the instrument that you're trading, you want to have the absolute most accurate data that you can possibly get. So if I was trading stocks, and I traded stocks for many years, I would want to get the most accurate data that I could find, pay for it. Okay, and when I traded stocks, I used to use CGQ, and I don't mind paying for it because it was very accurate. So if you're trading the forex markets, for example, try to find a true ECN, if you will. Okay, try to find a true ECN. I'll put up some information here on myself here too. One sec, guys. Let me just do that. Just to give myself a little bit of a plug here. Here's my information, by the way. If anybody wants to get a hold of me, I can be reached at Skype at SSB Trader. Here's my phone number. I take calls. Here's my email address. If I don't answer you on Skype or I don't answer the phone, it means I'm trading. Okay. I also do private coaching and money management for anybody that is interested in those particular things. Feel free to contact me about that. On to some more questions here. You're looking at a chart for areas of extreme highs or lows and areas of liquidity, and you trade in the direction of the trend or the profit from that liquidity. George asks a little bit of an important question here. How do you actually, when I coach people, what I do specifically is I design a method around them. Okay, because I'm a firm believer you cannot fit a square peg into a round hole. All right, so one of the problems that I believe that people have when they're looking for education is, let's say you go to a particular vendor who has some knowledge about how the market works, and they say, well, the market works like this, and this is how you should exploit that market, and that's great, but I find that if you want to do that, you have to make it your own. All right. So when I coach people, what I do is I kind of take all of your circumstances into play, right? So I teach you the general way of looking at the markets, right? Here's regular supply and demand. Here's where liquidity runs happen. Here's how the market works. Okay. Here's how orders flow. Here's how the dynamics. So I think it's really important to have an overall general education from the ground up of how the market actually works, right? But I also believe that you have to make it your own, right? So with anybody that comes to me for coaching, I'll teach you how the market works, and I'll say, okay, now you figure out how to exploit it, okay? Because the way I'm going to exploit it and the way you're going to exploit it, our personalities might be completely different, right? So if I try to teach you to do exactly what I do, even though what I do might be very profitable for me, you might lose money at it, right? If I just said, okay, we'll do exactly what I do. No, I got to teach you how the markets work, how to change your view and start to have you look at the markets like a trader, and then I'm going to tell you to develop a way for you to exploit the markets based upon your personality, based upon your your bankroll, based upon your time that you have available to commit to it. These are all factors that you have to take in when you're deciding to become a trader. These are all things that you have to make your own. Okay. I got a couple more minutes here. Andy asks, what would you do when there's liquidity on top and some below current price? How do you know where the most liquidity is and therefore determine direction? That's a very good question, Andy, and one that's not easily answered. Other than you kind of have to let other factors go into play. Okay, so I don't just trade liquidity. I also trade with sentiment. I also trade with price biases as well too. I also trade based upon supply and demand. So there's a lot of things that go into a decision. Not a lot, but there's several things that go into decisions whether or not to move into liquidity. Solomon asks how much I charge for my coaching. Vary a lot. I prefer people call me if you're serious about that, Solomon, because I do charge quite a bit of money, but that's only because I only concentrate on one or two people at a time. I won't take 20 or 30 people. That's just craziness. There's no way in the world I could guarantee that you would learn anything with 20 or 30 people. So I do kind of an exclusive program. Mike asked real quickly, what made you trade from stocks to forex? Quite honestly, Mike, I trade from stocks to forex mostly because I want to manage money right now, and to set up a legal hedge fund in the United States to trade stocks was very expensive and extensive, where I can do managed accounts in the forex markets for much cheaper, and I can pass those savings on to my particular clients. Okay, I think I got to go now, guys. Come back for my next webinar, and once again, I can't. Futures are great, English. I can't. I know some of you might be frustrated, but the more webinars I do, hopefully you'll get more little bits and pieces of the puzzle. And even if one of the two things that I've taught you right now helps you, then I've accomplished it. But remember, it's very difficult for me to give you everything in 27 years of trading in 45 minutes. So thank you. I'll be back next week. Thank you, FX Street. Thanks, Maud, and the moderators. Thank you very much. And once again, please feel free to call, email, or Skype me, and I'll do my best to answer more questions. And bye for now.